I'm not sure we've seen the bottom yet for Stellantis or Nissan. We're seeing lots of encouraging signs from those companies, but the sales are still declining, and profits per store are still far from where they used to be. And I think that for those brands, and we talked about that before, for newer dealers, for independent dealers who want to become a franchise dealer, those are good brands for them to acquire, because those folks that are independent are already good at the used business.
Today, I'm joined once again by Alan Haig, president of Haig Partners, for one of our most requested segments covering the state of dealership mergers and acquisitions. In this episode, we tackle a turbulent buy-sell market, from dealerships commanding record-breaking prices to brands struggling to hold their ground. Alan breaks down the key trends, the biggest moves, and what's next for dealership M&A. A big thank you to our sponsors for making today's episode possible: Lot Links, Busy Car, and of course, Haig Partners. And now let's get into the show. Alan Haig back on the CDG podcast. Alan, welcome back.
Thanks very much, Yossi. It's great to be with you again.
Great to have you back on. I had to do something a little fun. I said, this has to be like your quadrillionth appearance on the podcast. So I wanted to run some stats because I'm a nerd and I do these kind of things. So I did run some stats and I wanted to share them with you. First of all, fun fact, this is actually 2 years to the day, or roughly to the day, to the week of our first podcast together. So pretty incredible. You first came on to share your insights into, dealership mergers and acquisitions, just to the buy-sell environment, August 4th, 2023. Pretty crazy, right? I have more though. Other cool things that I learned. Literally on this podcast, we've gone through several cycles, OEM cycles, as I like to call them. When you first came on, we were talking about Ford's decline and then subsequent rise back up. From there, we went to Stellantis, right? I view this as like market cycles when I know not everyone's watching right now, but it's like they overlap slightly. And so it's like Ford rose, then declined, or declined and rose, then Stellantis declined, and then you'll tell us a little bit about how they're doing today. They have been rising, but we'll get more detail from you. And we'll also talk about who's right now declining and where the opportunity lies ahead. I think that's interesting. But get this. This is really cool. We ran some specific stats about the episodes. Total of 7 hours of airtime together. It's a record. Most used words: valuations, profits, and Toyota.
They're all closely related.
I know, right? Literally, it's great.
Yeah.
Brand mentions. You've mentioned Toyota 47 times, Ford 39. There's other brands as well, but these are the most significant. And it makes sense, right? Given all the change there. Blue Sky multiple has been said 93 times, and you average 11 times per episode.
Okay.
And final two, deal value discussed, at least where numbers were mentioned, $20 billion in transactions. That's pretty cool. Although we, obviously not everything has a number attached to it, but that's pretty cool. And the longest tangent, this one you have to guess, right? You had a monologue about something over the last 2 years. Now I know we discussed a lot, but just try to take a guess. What did you just talk about for 6 minutes and 42 seconds without any interruption from me?
Was it electric vehicles?
It's actually pretty close. Hybrid strategy. So
Okay.
Anyways, that's all I got for you. That were just some of the stats we ran. So I found it pretty cool.
6 minutes. That means I have a voice for FM radio. That's a long time to be talking about one subject.
6 minutes and 42 seconds, mind you.
And you still have an audience that's listening.
I know, it's pretty incredible. And it's grown. That's the most amazing part, right?
Yeah.
So, Alan Haig, welcome back to the pod.
Again, it's great to be with you. It's interesting to hear all those stats. I wonder if my family hears me say the same things over and over again as well.
Hey, people literally text me, and they're listening right now, and they say, well, when's Alan back on? Give us the goods on the M&A market. So we'll definitely do that today. One thing we haven't done before we get into I like to start with the pulse of dealership M&A. I say the vibe heading into Q4. How is Haig Partners doing, your firm? I haven't really asked you this question since maybe episode 1 or 3. I don't remember if I repeated in episode 3, but we've mostly only spoken about the industry. Meanwhile, you've been really focused on growing your firm, of course, working with more dealers. And a lot has happened in the last 2 years. How are you doing? How's your company doing? What's new there?
Well, the M&A space has been a hot space, I would say, since really even before COVID hit, but COVID really accelerated the pace of M&A. We saw dealership values double, and we saw M&A volumes double as well. And we've been trying to get our fair share, and maybe a little bit more than our fair share of that volume. We focus on representing mostly sellers, and we work coast to coast. We just added a teammate about a year and a half ago in Southern California, Jason Crouch. We added another teammate in Texas about a year and a half ago, Dave Rowe. Both of those gentlemen have long history of working with finance companies serving dealers, and also working in Dave Rowe was CFO at the Sewell organization for years. So we have a national presence, and we also want to have some local support. California and Texas are two of the biggest markets in M&A in our industry, Florida being the third, which is where our firm is headquartered. So we want to have a national presence, but we also believe having a little bit of local touch will help the dealers in those markets to maximize the value of their businesses when they choose to exit. So it's been a good run for our firm. We started with one person, and now we're 15 or so. So we're not a big shop. Deal volume wise, last year I think we sold a little over 55 rooftops, advised on the sale of those. And this year looks like it's going to be higher, probably in the mid 60s. Deal value has gone down this year, just as a function of dealership profits come down, so do blue sky values. So we're busier, running faster, but we'll probably make a little bit less money this year. Just like a lot of auto dealers are experiencing. Our business closely tracks the health of the retail business.
Yeah, it makes sense. You mentioned Florida, California, and Texas being the most prominent states for buy sells. Is that driven by legislation or like governance, where maybe in Texas and Florida it's so great and in California it's so not great? So they change hands, very frequently, or is it just simply volume of dealerships? They're large states, lots of, large populations, lots of dealerships.
It's a lot of the latter. You'll see that California, Texas, and Florida have three of the biggest populations in the U.S., so it's natural that they'd have more dealerships and that there'd be more volume in those states. I would say value-wise, the value of stores in Florida and Texas has just, I would say, skyrocketed in the last 10 years due to population growth, also due to business-friendly legislation and good franchise laws in those states. So we've had a lot of fun selling dealerships, particularly in Florida in the last couple of years. We were able to set record high values for BMW and Honda and Toyota and Kia, Mazda this year. So that's a function of how high the profits have gotten in those dealerships located in Florida, where you can have a high dock fee. The real estate's not too expensive. The labor costs are not too expensive. And there are relatively low rooftops per capita, which means you have high volume, which means you have high profits. So it's a good mix in Florida. Texas has the same, a lot of population growth, no income taxes, very favorable franchise laws, high profits per location, a lot of demand from buyers. So that's a positive mix. And I would say California has an improving situation also in terms of blue sky values, largely due to the changes the new administration has made to EV requirements, where they've kind of blocked California's ability to mandate that EVs have to be a certain percentage of sales, and also rolling back, related to that, the CARB rules, California Air Resource Board rules, that were creating some kind of scary requirements for dealers to sell a high percentage of their vehicles being EVs. And so that's been rolled back. And now whole brands are going to be able to make it. I mean, it wasn't clear how Mazda would have survived in California, for instance, because it didn't have any EVs in the time. They had very few hybrids coming. So I don't know how they would have competed at all. So California now, I think, has come back on the shopping list of some people who were perhaps avoiding it or concerned about it. And so we're quite active in California now. I think we have clients that own around 15 to 18 rooftops that we're representing in that market now, and the valuations we're getting are attractive.
Other than California, or before we get more detailed here, I want to start high level. Like, what's the general, as I call it, the vibe of dealers right now when it comes to buy, sell, the industry, as we're heading into Q4? Anecdotally, what are you seeing out there?
Well, I think almost all dealers are relatively pleased with their performance year to date in terms of profits. I mean, we have been enjoying very high profits since COVID hit us in 2020. And the new vehicle gross profits have been coming down kind of quarter by quarter, but now they've basically leveled off. And the total profits that dealers have been making peaked in 2023. It's been coming down quarter by quarter, but it's kind of leveled off. And the good news is it's leveled off at a value that's about 75% higher than the profits we were making in 2019 before COVID hit. So overall, industry is in a really good spot in terms of profitability. And I think a lot of dealers were hoping that this year we'd see higher sales, new vehicle sales. You know, we're down in the high 15s. We used to be in the low 17s in terms of millions of units of millions of new units sold per year. So we were hoping this year we'd have an uptick towards, 16, 16 and a half maybe. And I think that dealers are finding that's probably not going to happen due to a number of functions, largely due to affordability. The value per vehicle is still high. The interest rates are still high. There's now concern by some consumers. I'm hearing from my friends in South Florida, their traffic is down, and it's down partly due to ICE. The immigration raids that are happening. There are a lot of consumers in South Florida that probably aren't fully documented, or their parents aren't, or their kids aren't, or something. And so our friends in Florida have been saying that their traffic is down because people are staying home, or they're concerned about, putting out a lot of money to purchase a vehicle if they might get deported. So we see little pockets like that where there's some concerns. On the other hand, most people I'm talking to so far this year are flat or a little bit above in terms of their profits compared to last year. So we're in a good spot. The tariffs haven't fully impacted us yet. So I think dealers are wondering, how are the factories going to move around their production? The assembly, the parts, what brands are they going to promote? What brands are they going to just kind of take out? What's that going to mean in terms of pricing for vehicles for consumers? Who's going to eat this tariff? How much is it going to be? So the second half of the year, I think a lot of dealers are, showing up and wondering what's going to happen. It's impossible to project, I think, right now, the next 5 months of our industry.
This episode is brought to you by LotLinks. You work hard to move your inventory from price adjustments to paid promotion, but many cars still sit too long, eating away profit and resulting in markdowns. LotLinks helps you win with every VIN, with the industry's first VIN performance platform powered by AI to help dealers predict inventory risk early and act on it. LotLinks puts your vehicle in front of the right customers on the right channels with the right budget at the right time. The result? Cars that sell 37% faster than the market with less markdowns and holding costs. So visit lotlinks.com, that's LOTLINX.com, and win with every VIN, or click the link in the show notes below. The first manufacturer that was significantly impacted by tariffs was JLR, or I should say British manufacturers, right? There was the 10% tariff that went into effect. It was the earliest one. And I'm curious to know if you've seen any significant impact to M&A valuations, right? The actual dealership valuations driven by tariffs at this point. Like, can you pinpoint, like, hey, these brands, this much due to tariffs specifically? Are you seeing that yet reflect in the numbers as you're doing deals and transactions?
Very little. We have one transaction, which I think I might have mentioned on the last podcast with you, where our buyer, it includes 2 really good brands, A-plus brands, and an Audi store. And this buyer has been concerned about what was going to happen with Audi because Audi has 0 U.S. production. So Audi may be more impacted by tariffs than just about any brand that I can think of right now. And the profits of this store as a percentage of the total profits is relatively low of the group that we're selling. But nevertheless, the buyer did assign Blue Sky to it. So we're supposed to learn this week if they want to move forward with the transaction or not. So I think Audi has been hurt by this tariff situation maybe more than other brands I can think of, because they just don't have any U.S. production. And it could take 2 years for them to, maybe Volkswagen will convert a plant in Tennessee, for instance, to produce Audis. Porsche has no U.S. production. Porsche is going to get hit by a much bigger tariff. They're likely going to shift their production mix. Maybe they make fewer Taycans and more 911s. and the market for 911 has been drastically undersupplied in the past 4 or 5 years as Porsche was trying to move towards an EV strategy. So I think some dealers are saying, well, okay, if we don't have to sell Taycans and we lose money on those and our customers are unhappy because they depreciate so fast and we can sell some more 911s, that's okay. The customers are going to pay a higher price for 911s because there's a waiting list for them. So I think right now Audi's been hit the most. But in terms of other dealership values, I think all of us have to assume that the price of vehicle is going to rise by some percentage, 2, 3, 4, 5%. We don't know. But that's also about what they've been rising in terms of inflation the last few years.
Yeah, it doesn't sound very, it doesn't sound out of market. And we ran an A major, like a poll where we pretty much shared a chart where we shared the prices. There hasn't been much change. If anything, prices have declined since tariffs.
Yeah. So it's a good point, Yossi. No one really knows. I mean, the factories, of course, are screaming about this, particularly the ones that have factories in Canada or Mexico that right now they don't know what their future is going to be. How can you manufacture vehicles there and try to import them if there's going to be a 25 or 35% tariff? But in terms of what consumers are paying right now, there's not been a big lift. And I mentioned that South Florida traffic is down, but nationwide spending in the month of July on all goods and services was up pretty nicely. So it's like the consumers were waiting to see what the impact of tariffs are going to be. And that's been several months. It's been April 2nd was, I forget, Liberation Day. I forget what Trump called it. May and June, there was a little bit of what's going to happen. And then in July, people just brought their wallets out and started spending again. The same thing happened to dealerships. So right now, we've not seen a big negative impact, but we've also not seen the full impact of these tariffs.
Based on what you just said, is Audi a good deal right now, relatively speaking? Like, is there a little fear there, given the impact from tariffs, or are there any brands that dealers are leaning into disproportionately at a disproportionate rate due to tariffs? Anything like that?
Well, aside from tariffs, Audi had been struggling in the U.S. Their products had aged. Their major sellers were the Q5, the Q3, the A5, I think. And those products were pretty old compared to their competitors. So they had been steadily losing market share. And I think the dealers were increasingly frustrated with Audi. So in our latest Haig report, Q2, we lowered our blue sky multiple on Audi on the top and the bottom of the range by 1.5 turns. That's the biggest move that I can remember us ever making for any brand. And it's a reflection where some people just kind of said, you know what, I'm kind of done hoping that the future would be better, so I'll stick around this. And I'm going to assume that Audi is just not as desirable as even close to BMW, Mercedes, Porsche, Lexus, or JLR, some of its other competitors. They haven't made the moves that the other brands did, such as producing in this country, producing SUVs here.
Mm-hmm.
So we were already, looking at Audi with a lower valuation based upon what our clients and buyers and other folks that we talked to were telling us. The tariff situation isn't going to help, but I also believe that the tariff story is not over. It seems like it's just, everything's open to negotiation. I think the Audi people are in there trying to say, hey, if we build a plant in the future, if we commit to that, will you lower the tariffs today? So I think the talks are still going on, but that's the one brand we've probably seen the biggest impact on. And even before that, it was starting to suffer.
More broadly speaking, though, what's driving dealers nowadays to pursue acquisitions? And I'm not referring to internal reasons, right? Having, excess cash, but I'm talking about more of like exogenous factors, right? Are there things out there that are, giving dealers more of a push or kind of forcing functions that are leaning them towards certain brands versus others nowadays specifically?
I think it's confidence, Yossi. I think that dealers today, they've been hit by so many shocks over the last 10 years, whether it's the risk of electric vehicles, the risk of autonomous vehicles, the direct-to-sales model, subscription, Carvana, tariffs. You go through all these risks that dealers have seen and faced, And they can't control any of those things. They can't control the technology that's coming down the path, right? What they can control is the people whom they hire, the inventory that they order, the process they run at their stores, the service they provide to their customers. And when they focus on their businesses and take care of those things, the results are excellent. The profits per store are really good. And they look around, and you mentioned, aside from having a lot of profits, but that's a big part of it, because they look around and they figure out where else can I invest the $5 million I made last year after tax and get a desirable return that's even close to what I could get from a car dealership. If you put it in the S&P
Overall
500,
is still there. Mm-hmm.
yeah. And I think also every dealership that someone buys, a group buys, it in a small way should strengthen all of the rest of their stores. They're going to have greater capabilities. They can leverage their scale a little bit. They're bringing in more people to their organization. So the folks who are getting a little bit bigger, I think, are also getting a little bit better. And so that's a virtuous circle. And for those dealers that are young and hungry, they have lots of capital, they're able to buy these dealerships and get a good return. And they don't see all these risks that haven't disappeared. I mean, risk is always going to be out there. But it seems like the auto retail business model just manages to juke and jive its way to a healthy return on investment. So they want more.
That's a great point. And you mentioned Carvana. So get this, right? Yesterday I post about, a tip we received, and specifically the post goes, overheard Carvana's Chrysler Dodge Jeep Ram store went from dead last to number 3 in its district. Phoenix dealerships are nervous. Note that Carvana is also selling with no doc fees or dealer add-ons. That doesn't mean back end. It just, it doesn't mean all back end or warranties or vehicle service contracts, but certain add-ons. Anyway, so some people were posting comments. One follower mentioned, he said, hey, this is available for all CDJR dealers to see, but note that they are selling Jeep well, but not other brands, and also that they only sold 101 vehicles out of 618, meaning extremely high day supply, inefficient turn. Okay. Anyway, I got a DM at night from I'm not going to say who, but someone that has internal data. And they specifically told me, they said, hey, that's wrong information. Carvana is crushing at it's their first franchise store. We know CarMax ran this experiment, ended up divesting, but Carvana's kind of leaned in here. And I'm getting to the punchline. There's a punchline here. So Carvana, they only had 180 on the ground to start July, and they sold 101. And by end of this month, August, they'll likely have the biggest new car inventory in Arizona for CDJR. It's a really big deal. By the way, this is all just in my DMs. Like, this is not even public, right? And the reason they sold mostly Jeep last month and not Ram is because the Rams are taking longer to get there. So they're not even there. So I think the bottom line here, as you mentioned, Carvana's done something very interesting at the store by deploying again, it's not called Carvana Auto Sales, but the point is they are deploying, certain things that are, Carvana-esque, such as no doc fees and whatnot. And the store is crushing it. By every measure, I mean, it seems like the store is doing extremely well. And here is the crazy part. A large Carvana investor, and I mean large, we're not talking millions here, we're talking, big money, hundreds of millions, if not billions, actually, frankly. He sent me a text, and he wrote, fun data point on Carvana's new business, and then he wrote, all the cars. So what that signals to me, again, I'm speculating, totally speculating, but I think this signals potential. And again, this is just an investor, and I'm not going to name them. This isn't any public information. This is just banter. But the point is, this signals to me that, Carvana, it seems like there may be long-term interest here to continue pursuing this experiment. It's not rocket science. I mean, they've clearly bought one. But do they want to continue buying more? Has anything about Carvana, have you had any conversations with dealers about this kind of stuff? Is this even are dealers even discussing it with you in your circles?
I don't think it's very well known that they own that store. I remember years ago, this is probably 10 years ago, when I first heard of Carvana, and I was looking at buying a Jeep Wrangler for this vacation house we have here in Massachusetts. And my wife and daughter wanted a 2-door model, and there were very, very few of those around. One of my friends had a store. They had a couple in stock. So I, went and looked at it or at them. And then a friend of mine says, check out the Carvana website. I went to the Carvana website and they had 37 in stock in my area. And the photographs they had were amazing and fully described. They had the original Monroney sticker you could click on, and they would bring the vehicle to my driveway the next day. And I remember thinking, this is unbelievable from a consumer standpoint. I didn't know if price-wise it was competitive or not, but the convenience and the description of the vehicle was a lot better than franchise dealers were doing at the time. So I could see Carvana wanting to play in the new car space. And of course, Carvana makes a lot of their money on the finance side. So I don't know if that's what they're doing now too. If they're just pursuing a volume model. There are other dealers that have done that over the years. Where, there's the Dave Smith's store out in Idaho, where they were selling, and they still are selling tons and tons of mostly domestic vehicles. So it's an experiment for them. I read a analyst report. Adam Jonas recently covered them. They're very bullish on the future of Carvana. I think they view that the stock could almost double in the next year based upon their progress. And so I don't know anybody who's betting against Carvana. If you did bet against Carvana, you lost your shirt recently because the stock price has gone up so much. So this is yet another threat, if you will, to franchise dealers. Maybe it's also, competition, steel sharpens steel. So maybe this will be
Good way to look at it, yeah.
a lesson, if you will, if you're watching Carvana take a small store and make it into a big store. You wonder, could a franchise dealer do that as well? Does it require the might of Carvana? How are they doing it? How are they getting the new car customers? There's another factor too, though, is that, they're choosing to do so right now with Stellantis, which has got a surplus of new vehicle inventory. I don't know if they bought a Toyota store in today's world, they'd be able to get the inventory to do what they're doing. So, I think it's smart what they did to buy a Stellantis business because they can get all the inventory they want and experiment with this and see what works. It's impressive to see that they've grown so quickly. It doesn't surprise me. They have probably the best website in auto retail that I've seen, including with the public companies, in terms of the ease of interacting with it as a consumer. And they do something really clever, which is when they show you all the vehicles available, many of them are kind of grayed out. You can see it, but you can't actually click on that vehicle. And it says that another customer is in the process of purchasing this vehicle. If they don't do so, we'll let you know and you can buy it. But that gives you the impression that this inventory is going fast. I got to get in there and buy this
like
vehicle.
seeing customers on the lot looking at the vehicle you're interested in. It kind of replicates that. I mean, listen, the best websites, the best experiences online are simply mimic the the human nature of an in-store physical experience.
So you started a business where you were selling used vehicles online, right? And that creating that sense of urgency, transparency, et cetera, it's not easy to do, but I think they've done a really good job with it. And again, I'm hoping that other retailers will adopt some of the strengths of Carvana in order to compete with them.
This episode is brought to you by BusyCar, powering CDG's recall tracker. Fixed ops leaders. With new car sales under pressure, your service drive matters more than ever, and the hidden retention goldmine is recalls. That's why we partnered with BusyCar. They've already helped dealers generate over $225 million in recall revenue effortlessly. CDG's recall tracker monitors 70 million plus vehicles with open recalls, packed with insights, timelines, fixed status, campaign numbers, everything you need to bring lost customers back. So transform your recall management today and get more customers in the door using recalls. Go to cdgrecalls.com. That's cdgrecalls.com, or hit the link in the show notes below. Yeah, I mean, for a long time, there have been lots of e-commerce websites that simply put these like fake, X amount of people are viewing these and they're fake. In Carvana's case, it's real. As far as I know, it's 100% real. We actually tried to replicate it, and at the time, it was challenging because you had to have these APIs ping something at a certain, whenever someone was viewing it for X amount of minutes. And so it's this whole process. But the point is it's real, and it replicates the physical experience of a consumer seeing another person looking at a car that they maybe want, creates that FOMO, feeling. And then okay, I want to buy it. I'll take it, right? Before someone else takes it. So Speaking of Carvana leaning into a franchise in this case, which we've known about for months already, and it seems like this experiment is, playing out pretty well by traditional dealership standards, at least. It seems like the public groups have sort of leaned out of acquisitions this year, or are not leaning in as far, I should say. Whereas private groups are continuing to accelerate and, gobble up as many stores as they can. What's up with that? Why are we seeing this shift where privates are growing significantly more as far as acquisitions versus publics?
It's a good point. You're correct. The number of dealerships acquired by public companies is down this year. Year to date, they bought 13. Last year, through the second quarter, they bought 22. Overall, M&A is down too. Total store sales are down about 39%. I think the public companies are active. We talk to them. We're showing them opportunities. And the public companies have got a couple different ways they can spend their capital. One is through acquisitions. One is through investing in their stores, expanding their existing stores. And the third is through stock buybacks. And I think that they've been spending more money buying back the shares than they have been buying the dealerships. There's been there can be sometimes a disconnect between what a seller wants for his business and what a buyer wants. And if I'm a public company CEO and I'm not sure about what impact tariffs are going to have on the future profitability of dealerships,
yep.
Maybe I just wait a little bit. Maybe I don't aggressively buy stores in this environment until I see how my stores are going to perform. So I don't know that, if you listen to the earnings calls, you can hear some of that. But everybody's saying we're interested in acquisitions. If we find ones that meet our ROI, our return on investment requirements. But I think that the tariffs have caused a slowdown. Last year, there was the election cycle. People weren't sure who the president was going to be. Interest rates are still a little elevated. So I think there are a number of small factors that add up to buyers moving more slowly in this environment, deals taking longer to close, making it a little bit harder for there to be an overlap between the bid-ask spread. My first job, I went very green to the first meeting that I had in this investment bank firm I was with. And the CEO, the chairman of the firm said, okay, for everyone's new out there, and there were, 50 analysts and 50 associates that were new. They said the job of the investment banker is to get the bid to exceed the ask. Then your job is done. And I think the ask right now has been higher than the bid so far this year. But as we see the year progress and as profits are strong, I think the bids are going to start to come up again. And I think also, if you're a seller, there's also some caution for sellers. Is this the right time to sell your business and maximize the value of it? Because profits are really strong, but if buyers are waiting a little bit for the impact of tariffs to happen, maybe they're going to wait too. The reality is the values we're seeing for buyers and sellers that are in the market, the values are strong. We estimate, before we go to market, often before we're hired, we'll give a potential seller a range of blue sky that we think their value will be in the marketplace, what a buyer would pay for their business. And we track the results compared to the estimates. And this year, I think the actual results, people who have accepted blue sky offers, is more than 20% higher than the midpoint of the range that we estimated to them before they went to market. So we're pleased with the numbers we're seeing, and I think our clients are. If you have expectations that you're going to get paid today, what your business was worth 2 years ago, you're going to be disappointed. That was a window that was open, and now it's still open, but not at the same value. So I think what we're seeing is a little bit of return to the normal volume of M&A transactions. Before the pandemic, we were seeing 350, 400 stores trade per year. We may get back to that level. This year so far, we've seen 190 stores trade hands. So if you double that, you'd be at 380. That's a little bit above what we were before the pandemic hit. So some of this is a normalization in terms of deal volume.
Mm-hmm. Off the record, I have some dealers that are telling me about, they're seeing more distressed deals. Are you seeing that from your end as well?
Absolutely. We had the pleasure of selling some dealerships for record high prices over the last couple of years, and that's really fun. The clients are thrilled, we're thrilled, the buyers are excited to buy these stores, and we're making so much money. But as the effects of the pandemic wore off, a lot of stores began to tip over from making money to losing money. And certain brands in particular have been suffering more than others. So Nissan, Infiniti, Stellantis, those are brands where people have said, well, I made some money during the pandemic, but I don't see a path to profitability right now, so I want to sell them. So those have been some brands that I would say have declined in value quite a lot. I'm not sure we've seen the bottom yet for Stellantis or Nissan. We're seeing lots of encouraging signs from those companies, but the sales are still declining, and profits per store are still far from where they used to be. And I think that for those brands, and we talked about that before, for newer dealers, for independent dealers who want to become a franchise dealer, those are good brands for them to acquire, because those folks that are independent are already good at the used business. They're good at acquiring used vehicles from consumers, from other sources where they can make a healthy margin. And if they can bolt that used car business into a new car business and get the fixed operations and more F&I, lower floor plan costs, that's a really good opportunity for franchise buyers now to come into the franchise system. During the pandemic, when every franchise was worth a lot of money, it was very difficult for independents to enter. And now we're also seeing, the factories, some of them want to see new ownership of their dealerships because they've seen the new car sales decline. They want some young, energetic owner in there who's going to be working 24/7 to build their business into a success. So we're seeing turnover on some of those brands at higher levels. Nobody's rushing to sell a Lexus store. Nobody's rushing to sell a Porsche dealership, even though they're more challenged today than they have been. Nobody's rushing to sell a Mercedes or a BMW dealership, Toyota dealership. A lot of those brands are just as good or better than they have been for quite some time.
So let's say you mentioned Stellantis, Nissan, Infiniti specifically. They're still struggling. I know Nissan did just announced a revamped QX80, which seems to be, an exciting move for them. We'll see when that actually makes it to market and what impact it has on the stores. In terms of brands where you're seeing the most interest, has there been any movement there? You just mentioned where people are not, let's say, rushing to sell, but anything where you're particularly seeing a rising interest other than Toyota?
Well, in our latest report, we made 4 moves. I mentioned we lowered Audi by 1.5 turns at the high and low end of our range, and that's the biggest move we made. We did increase Toyota a little bit on the bottom end of the range. I think we increased it a 0.5 turn, so it's just 7 to 8 times now, I think, is our multiple. We increased the bottom end of the range or I think it's both ranges for Hyundai and for Kia. Those brands continue to perform well. They've got the mixed powertrain of EV, hybrid, etc. So we increased both of those a 0.5 turn at the low and on the high end, or just on the high end, excuse me. So, it's every quarter you see a little bit of movement, and the Asian imports are doing really well, and so we see increased demand for them. Last quarter, we highlighted General Motors, Chevrolet in particular, well, really all the brands that were doing really well, and dealers were telling us that they'd never seen a better product mix, better product lineup for those brands, even though they really only have 1 car or 2 cars left at Chevrolet. They have a Corvette and a Malibu, I think. That might be it. So they're so heavy on trucks and SUVs. But the quality, the margins that our dealers are getting, the fixed ops are amazing on the domestic side. So we still see, good demand for those brands. I think that Mary Barra has done a great job slowly making her business really profitable. Jim Farley announced in the news recently they're going to be coming up with a new line of low-cost EVs, which I applaud, because eventually this country will need to be competitive with EVs with other global manufacturers. And there is a need for low-cost trucks for people to use. So that could also increase sales. I don't know if that would just be cannibalizing Ford sales. I think it could increase their sales. So there's some good news out there that we're seeing.
I was going to ask you about that Ford. I mean, Ford had their big announcement with their, low cost EVs, just like revised or updated EV infrastructure in general, which could in theory cut their loss on producing EVs from like 44,000 to 22,000. A lot of very positive signals, as they claim. Still a big
Yeah.
price, of course. I think it's too early to ask you if that's impacting the Ford M&A market, because this was literally just announced. You can tell me, if you think differently. How do you just reconcile this? Ford is at this point quadrupling down on EVs. Toyota is still very hybrid heavy. Is Toyota being too myopic at this point? Will this hurt dealership values long term? Obviously, it's going to follow profits. But I mean, listen, I got to tell you, I've tested a bunch of EVs recently. I'm enjoying it. I mean, strong torque, quiet. They're becoming a little bit nicer. If you have charging infrastructure near you, which, I mean, I do in the area we live, there's plenty. I realize many don't. But I would say from our first conversation 2 years ago to today, a lot has evolved. And I'm curious if other consumers out there feel that way as well. But yeah, I mean, at what point is Toyota being too myopic, or are they leaning in just the right amount? Because they are producing some EVs now, right? So are they doing it at the right pace? What's your take?
Well, we're about to get a very clear view of what the demand is for EVs in this country because the incentives are disappearing. Right? There was a $7,500 tax credit for purchase of a new unit and
End of September.
3,500 or something for a used unit.
Bye.
Yeah. So when that disappears, we'll see how consumers respond. What is the true value or demand for that? I think with the incentives, it was around 9%, I think, of new vehicle sales. Without it, what's it going to look like? And unfortunately, the vehicle category that's done worst with EVs has been on the full size truck side. The Silverado EVs and the Ford Lightnings. The actual sales of those units have been far less than what their factories were expecting, and they've lost billions of dollars selling those units, and dealers have lost billions of dollars selling those units too. So will we see demand rise if the vehicles are less expensive? Yeah, I could see that because I could see a lot of these vehicles being used by local fleets. The Terminex truck, the grass guy, the pool guy, all those people that are driving 40, 60 miles a day just kind of on a local circuit, go back home, plug in, not have any fueling charges, not having fewer maintenance charges. I could see that being a whole category that people would want those vehicles. But it's to be determined, EOC. I don't think that anybody's looking at this announcement saying, okay, now I'm going to go buy a Ford store. I think that, the dealers that have Ford stores felt burned by Ford by how much money they had to invest to create this charging infrastructure in their stores. And then the sales were never there to support the investment. Mm-hmm. I think there's also, some concern about the Ford quality. There have been way too many recalls. And while that feeds your service department in the short term, it's good. But if your customers get turned off by the constant recalls and they defect to Toyota,
it's been challenging. Ford recalls are, breaking records here. Well, I mean, we cover them. And myself as a consumer, in the morning when we're covering industry news, I'll go on our website, I'll read our news, I'll read our newsletter, and I see Ford recall. It's become, it's definitely a pain point in a big way. They got to work on this.
I remember, I don't know how many years it was, decades ago, but quality is job one. That was a Ford advertising mantra back in the 80s, maybe. I think it was 80s or 90s. And, rather than new products, I think some dealers would say, hey, how about we fix ones we have so that, they enjoy the recalls, don't get me wrong, but I think that when they hear the customer saying, I can't believe I have to come in here again, is that going to hurt retention, which is huge and harder than ever for factories and dealers to keep those customers than it was before. The loyalty is just less than it used to be. And if you have all these recalls, that just erodes loyalty.
This episode is brought to you by CDG Recruiting. Here's the truth. Top dealers don't leave talent to chance. That's why I built CDG Recruiting, the go-to talent partner for dealers who want the best. We're placing general managers, F&I talent, service directors, controllers, you name it. From the showroom to the C-suite, we work with dozens of the largest groups in the country. So if you're working with us, you're in good company. And because we've built the largest audience in automotive, backed by over 180,000 industry professionals across our media platforms, we know exactly where to find the people who can move the needle for your store. If you're ready to stop hiring like everyone else, go to cdgrecruiting.com to book a free call. Again, that's cdgrecruiting.com or click the link in the show notes below.
I want to circle back to underperforming stores because we spoke about if you're seeing a higher volume, and you said you are. My follow-up to that is, what's driving underperformance? Or is this like, segmented to specific brands? Can you share more details there?
A lot of the health of a dealership has to do with its throughput. How many new units are they selling? How many used units are they selling? If you have high throughput, you can have high profits, and if you have high profits, you can afford high quality people. And if you have high quality people, it's easier to maintain and build profits, right? It's a virtuous circle. And if you own a brand, let's call it Nissan, and there used to be, 1,200 units per year sold out of a Nissan store, and they lose enough market share, so now it's maybe 900 units at that location. Your general managers may have left you. Your sales manager, your F&I, your used car guy, your service department might have left because they're making less money at that store as the volume declines. So as the desirability of the new unit declines, so does the throughput per location, so does the profitability per location. It all connects, right? You're going to get fewer trades. You're going to have fewer shops or fewer reconditioning because you have lower used car sales. You're going to have lower warranty repairs because you have lower new car sales. So it all circles down based upon your new car volume. Now, for volume brands like Nissan, they have far too many locations now given the number of units that they're selling in this country. And the same thing happened with Ford and with General Motors and with Stellantis. Their dealer networks are all built probably from the 50s to the 70s when they were selling more cars than they are today. And we have a conference coming up in Las Vegas in September. One of our topics is going to be how to create value in the Ford network through dealer consolidation, where if there are 6 dealers in a metro, there's probably one guy who's in his 80s and he has a piece of real estate downtown that might be better used as an apartment building than a car dealership. Work to buy that store and close it and share the customer list. And the surrounding stores will have an instant lift in profitability without having to spend any more money on service stalls or advertising or anything else. They're just going to get more volume. So unfortunately, when you get these brands that decline in market share, it's very hard to sustain the profitability at the retail level. And the former chairman at AutoNation had a phrase which I recall vividly, which is there's a battle for talent and capital at auto retail. And that talent can bleed away across the street. The used car manager at Nissan becomes the used car manager at Honda or Toyota or Mazda or Subaru or Kia or Hyundai. And he's taking with him knowledge and probably some of his people. He's going to take some service writers too. And you can replace him, but it's a little bit harder to hire somebody in a Nissan store today than it is a Subaru store, just because the perception of one brand's doing well and the other one's suffering. So unfortunately, when the new car volume starts to drop, it becomes a tough situation to turn around. And I know the team at Nissan is working very hard to increase sales. And I know that Nissan's dealers are working hard to increase sales. And a lot of that comes from product. And I am encouraged that the product I see coming from Nissan, it does seem to be nicely styled. It seems to be nicely priced. They have a lot of products below $30,000, which is what customers want today. So we're hopeful that Nissan will recover. But in the meantime, a lot of dealers have said, I'm out. I don't have the talent to run this business in a way that's going to make me a nice profit, so I'm going to sell it.
Yeah, that's also what I'm hearing. I mean, from dealers I speak with, it's simply, really the number one thing I hear on Nissan is, hey, too many dealers, right? Like consolidate the dealer network. Do you have too many dealers, too many points, and it's just adversely impacting their sales. And it makes you wonder, what is the best way to fix that? Because I think there's a bit of a conflict of interest, or not a conflict of interest, but it's expensive for Nissan to, reduce dealer count. Is there a better way to solve that dilemma?
I don't know that. I mean, General Motors spent a lot of money closing Cadillac stores and closing Buick stores, and the results have been positive for the remaining Buick and Cadillac stores. They're doing a lot better. And I think the goal there is when you walk into a Cadillac store, it feels like a real luxury experience. It can compete with BMW or Mercedes or Lexus, et cetera, because they have a professional staff, they have a nice facility, they're in a good location. And so it's been positive what General Motors has done. Ford has also been active in closing points. And I don't know the direct impact. I'm trying to get that data on, when you close one store, what happens to the other five, if you will. But I know from my days at AutoNation, when we had a dealership, let's call it a Honda store in a metro, let's just call it Atlanta. And if Honda decided to add another dealership near ours, a contiguous point, we would lose about 30% of the profit over the next 3 years. So if the inverse is true, if you have a competitor that goes away, that you could pick up 30% profit over 3 years, that's a very powerful way to create value in a franchise system. If the franchisor, the factory, has the money to support, or if it's actively supporting in other ways. I don't think Nissan has the money today. I think that they're fighting to invest in product and incentives to benefit consumers. So I think the dealers that have Nissan stores today, that for them to make a good return on investment, they've got to be very good at used and fixed ops and F&I. And unfortunately, I've heard the chargebacks at Nissan stores have jumped considerably in recent months as some of their former customers are refinancing or selling out into different brands. So it's just, they're facing a number of headwinds. Product will fix it. A better business model will fix it. And I'm hopeful that's what's going to happen here in the next 18 months.
Likewise, Alan, as we're about to wrap up here, what are you excited for the next 3, 4, 5 months? I wouldn't say Q4 just yet because we have another month here, but what are you personally excited for?
Well, on the business side, we want to close a lot of the transactions that we have under definitive agreement. We've got 34 stores that we've sold year to date, and we've got 25 stores that are under definitive agreement. I just checked. We've got 8 more stores under letter of intent, and we've got 36 other stores are representing where we're about to go to market or we're in market. So
very
professionally, I'd like to get those transactions closed on healthy terms. We're also organizing a couple of conferences that we're going to be having in September and then at NADA, which I believe maybe you'll be sharing some news about that, Yossi. But on a personal side, I would like to raise a plug if I can, which is on November 3rd, I'll be running in the New York City Marathon. And I'm going to be raising money for Memorial Sloan Kettering Cancer Center. And for those of you who have had family or friends or yourselves impacted by cancer and you want to donate to try to cure cancer or solve cancer or treat it better, please go to fredsteam.org and you can make a donation there. I promise you I won't be running quickly in that marathon, but I will finish it. And it will be a great joy for me if you would join in supporting Fred's team and raising money for Memorial Sloan Kettering.
That's awesome. We'll put this in the show notes as well. It's a good gesture and appreciate that. Very cool. And I didn't know you're a runner, so that's cool as well. So Alan, close us up. I mean, give us your prediction. 3 to 6 months. I don't want to go a year out, give us next couple quarters. What's what are you sensing here is happening next in our market? More stability, an increase, a decrease in M&A. What are you seeing?
I can't predict any increase in stability in the political front because there just seems to be so much drama there. I think that we can assume that the invisible hand of the market, Adam Smith's term, that the OEMs are going to figure out a way to change their model lineup, change their inputs, where they're manufacturing, where the parts are coming from, to minimize the impact of these tariffs on everyone's business. I think that new dealer profits will remain high. I think that the demand for M&A will remain strong. I think the public companies will continue to buy stores. The private consolidators are going to keep going. I think that the challenges that we've had in the past on the technology side for dealers are going to have to continue to adopt. You mentioned Carvana. They have, in my opinion, the best website and maybe one of the best captive finance companies. dealers are going to have to find a way in Phoenix and any other place that Carvana might buy stores to respond. And I'm hopeful that the brands out there that are struggling will adopt some of the strategies and tactics that the leading brands use to help their dealers. So Toyota, Honda, et cetera, where they have a good partnership between the retailer and the factory, that others can adopt those methods so that the weaker brands can get stronger. We're all about trying to pull those folks up because we feel bad for our friends that own some of these dealerships where they spend millions and millions of dollars on them. They spend dozens of hours every week struggling. They deserve to get a good return on their investment on their time. So I'm hoping the weaker guys get stronger and the strong guys stay. And this market that we've enjoyed that's been so strong the last 5 years continues.
Well said. Alan Haig, Haig Partners. Alan, thanks for joining me again. This was great.
Thanks for having me, OC.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.